David was in Chicago, and he came to my office, which was in an old building overlooking campus, and I said, here's some results that French and I are working on. I showed him on my computer what we had come up with in the way of the differential returns of high book-to-market stocks versus low book-to-market stocks. The names value and growth didn't exist at that time. And he looked at it and said, holy smokes. He says, there's a business opportunity there. And I said, we have this risk story, too, that we can put to it.
The idea that value outperforms growth wasn't new. I mean, that'd been around for a long time. It may be defined differently. And of course, Fama and French did it more scientifically and, quantitatively, they really nailed these things.
Fama and French didn't invent the value effect any more than Ben Franklin invented electricity. He found a way to understand it better.
It wasn't until we realized, this is a really nice way to frame the investment process, thinking in terms of these dimensions. And it's just a very easy way to explain where your portfolio is within the framework of size and value versus growth.
For the clients, this was a new, revolutionary, interesting idea.
Made it easy to explain the value effect and the size effect, because now you had a model and you could say this is related to risk.
When Fama and French came out with their work, and I remember seeing their original work presented in the conference room in Santa Monica.
Gene was there that day to give us this lecture on this paper that he was about to release, and we sat there, like students lined up, and he was up there preaching.
The day that, we decided to launch, strategies based on the Fama French three-factor model, that changed the course of Dimensional in a way that none of us could, I think, have anticipated.
DFA, within 1993, came out with the Fama French research, and by that time, it allowed DFA to move from being a niche institutional player to a full, complete solution firm.
What that allowed us to do in developing our strategies and developing our, clients and working with them really kind of changed everything.
They started off with the US small value, and then gradually they started releasing these other products.
As the investment started to grow and the investment community started to respond to those products, we really realized that we had something that was very special there.
I think what really helped launch the firm on a comprehensive way of managing and looking at the entire set of securities was this multi-factor approach.
The thing that the three-factor model is so great about is that it actually breaks down the walls between products, because it essentially makes the total portfolio position relative to these risk and return factors the important decision that an investor has to make.
It takes a little while for it to be intuitive, but once you understand it, it's a very, very powerful tool. It's a very powerful compass. So we, in effect, with that, provide the compass and then the tools to help advisors be successful.
The Fama French research fell on very receptive soil, so to speak, with these advisors. They put up money to start some of the funds. And so that created momentum for Dimensional to really implement the three-factor model.